The mechanics of an options contract. Understanding the mechanics of an options contract is fundamental to trading. Each contract specifies the following components. Contract specifications: underlying asset, the security or asset from which the options contract derives its value, e.g., a specific stock or index. Strike price, the predetermined price at which the buyer of the option can exercise the contract. Expiration date, the date when the options contract becomes void. Contract multiplier, for stock options, this is typically 100, meaning one contract controls 100 shares of the underlying asset. Parties in an options contract: buyer, holder, the person who pays the premium for the right to exercise the option. Seller, writer, the person who receives the premium and is obligated to fulfill the terms of the contract if the buyer exercises the option. Exercise and assignment: exercise, when the buyer uses their right to buy, call, or sell, put, the underlying asset at the strike price. Assignment, when the seller is obligated to fulfill the terms of the contract upon the buyer's exercise. Reading an options chain. An options chain is a table that displays the available options for a particular underlying asset. It provides crucial information traders need to evaluate potential trades. Key components of an options chain: strike prices, listed in the middle of the chain, representing the price levels at which options can be exercised. Expiration dates, typically categorized into weekly, monthly, or quarterly expirations. Premiums, represented as the bid price buyers are willing to pay, and ask price sellers are willing to accept. Volume and open interest, indicators of market activity and liquidity for each option. Greeks, measures of risk exposure, including delta, gamma, theta, vega, and rho. Practical tips for navigating an options chain: focus on contracts with higher volume and open interest for better liquidity. Compare premiums and Greeks to assess the risk-reward profile of potential trades. Use filters provided by trading platforms to narrow down choices by expiration date, strike price, or other criteria. Understanding margin requirements for options trading involves specific margin requirements, particularly for sellers who bear higher risk. Margin for buyers. Buyers of options are not subject to margin requirements beyond the premium paid, as their maximum risk is limited to the premium. Margin for sellers. Covered positions. Selling a call when owning the underlying asset or selling a put with sufficient cash to cover the purchase requires minimal margin. Naked positions. Selling options without coverage requires higher margin due to unlimited potential risk. How margin is calculated. Margin is determined based on factors such as the strike price, current price of the underlying asset, and volatility. Brokers use algorithms like SPAN, Standard Portfolio Analysis of Risk, to calculate margin requirements. Basic pricing concepts. Understanding how options are priced is key to identifying opportunities and risks. Intrinsic value. Definition: the difference between the underlying asset's current price and the option's strike price. Formula: for calls, intrinsic value equals max, 0, current price strike price. For puts, intrinsic value equals max, 0, strike price current price. Extrinsic value. Definition: the portion of the premium that exceeds the intrinsic value, reflecting time value and implied volatility. Factors influencing extrinsic value: time to expiration, longer durations increase extrinsic value. Volatility, higher expected volatility raises extrinsic value. Total premium. Formula: total premium equals intrinsic value plus extrinsic value. Key considerations for beginner traders. Start with simple strategies. Begin with single-leg strategies like buying calls or puts to understand the basic mechanics without overcomplicating trades. Understand break-even points. For calls, break-even equals strike price plus premium paid. For puts, break-even equals strike price premium paid. Monitor market conditions, assess volatility and trends in the underlying asset. Thanks for watching Module 2. Please like, share, and subscribe, and see you in Module 3.